In this video, I'm going to be going over how a lot of traders get trapped, or newer traders get trapped within this kind of loophole, and kind of the way to get out of it, in my opinion, and kind of the methods I've taught my students and how to get out of this specifically. So let's get into it straight away. The trap essentially is implementing a strategy. You find the strategy you want to test. You then test it for a little while. If we just put the little pointer on here, you test it for a little while. It doesn't work. You move on to the next strategy. You implement a strategy, and you fall into this rut consistently implementing new strategies just to find out it doesn't work and moving on to a new one. It's just a very infinite loop, something that will not get you consistency over the long term because you're constantly chopping and changing what's working, what's not working. And let's get into kind of how I'd recommend getting out of it. It might not be the longest of videos, but I really do recommend you kind of watch till the end on this one. So moving on to the next step, it's going to be focusing more on your input over your output. Now that's going to be requiring discussing thought processes, having like a thought process diagram, which I'll go into in a minute, having and just being aware that P&L will have variance. Okay, so if we just move on to the next slide quickly here, going over this is where a lot of people kind of get mixed up, in my opinion at least, right? And where they'll get mixed up is they'll go, well, this is a good trade, this is a good trade, this is a bad trade because they lost money, this is a bad trade, I lost money, I did something wrong here, I did something wrong here, I did something right here, I did something wrong, and so on. You can get the gist of it. People are basing the outcome of their trade, being the P&L, determining whether they did something right or wrong based upon the outcome of the trades, the output. Hence why I just go back quickly, hence why I'm focusing much more on the input of your trades rather than the output to begin with. Okay, a lot of people will be focusing on the output, again, just to refer back to it, being the output, being the P&L, your end result, and this will have variance, okay? This will have drastic variance, meaning, your P&L, in my opinion, is not a direct metric at all as to whether you followed your rules or not. You need to implement into your brain that you can lose trades and you would have done the right thing. That is just the way variance works at the end of the day. And if we go on to the next part, escaping the trap, okay? Escaping this kind of thought process cycle is going to be the most important part here. And that's going to be create a thought process diagram, question flow diagram, which I'll show an example of later on. Follow that consistently for a while and then review your trades differently. Okay, so I'm going to come back to this question of the question flow diagram in a minute on like a bit of a breakdown for you there, but I'm going to show you how to create one of that and then using this same formula. But what we then want to do after you've done this is essentially, this is what people are going to be looking at. Okay, this is what you might find out is that you have a strategy, you have this is the P&L, and this is the thought process check. This is what I mean by your output is not directly correlated to if you've done something right or wrong, because this is the thought process check column that you can kind of create in your head, or I'd recommend on a column of some sort. And it may be, okay, within this trade here, you followed your thought process check. Yes. In this one here, you won money, but did you follow this thought process check? If the answer is no, you still did something wrong on this trade here, even though you still won more money. You still won money and you still had a good trade in terms of P&L relation, but this means you're not going to be actually essentially, you didn't follow your rules. You didn't follow certain protocols. You didn't follow your flow process. In that sense, you didn't follow the checklist in which you're, is this right? Yes, no, yes, no. And I'm going to go through that in a minute. But you can see here, even if you lose a trade and you follow the thought process checklist, that is a good trade in business for you. That's what I'm trying to get into your heads. If this is a yes, then regardless of the P&L, you are doing the right track in terms of consistency and looking for like the end result will be much better if you're following this kind of the thought process checklist. Okay, so do not directly think that correlating your P&L with it being a good trade or not is the right way to be going about things. Now, once you got to this stage here, so previous slide, remember, thought process check, you had no's in a few places. This is inconsistency. This is not what you want to be aiming for. Okay, regardless of P&L, kind of disregard this whole segment here, disregard everything you see here. This here is what you want to be aiming for. Aim for every single column to be checked as yes. That will then give you generally a reliable output, okay, in sense of, the variance, the P&L over expected long period of time, the trade expectancy, the average R, the win rate. That is going to give you a much more reliable output if you're following a consistent thought process check, okay, before you take any given trade. Now, if you're going onto this one, this is what you're going to want to be aiming for, essentially, is aiming for every single thought process check to be yes. That would mean that your output and your P&L is a much more likely, a much more better representation of what your strategy is. It's more likely that this strategy and the output you're getting is actually more accurate rather than if you're having an inconsistent thought process check before, because otherwise this is the input. This is the input. This column here is essentially the input, and this is the output. If you do not have a consistent input process, the output is going to be widely varied, already more than it already is, due to just market variance as a whole. Okay, and your strategy having variance. I think that's really important to note, because if I said to you something's got a 50% win rate, that doesn't mean you're going to win, lose, right? It means you could win 10 in a row, you could then lose 20 in a row. That's the importance of variance in this case, and it's why it's so important, why I preach to my students kind of everywhere, that this process, the thought process check, which we're going to go over in a second, how to create one, it really must try and aim for the line of having yes on each consistent column. Once you've done this and you've got everything saying yes, that is where you can then start reviewing the trades and discussing the following few kind of variables here. Tinker the thought process strategy after consistency, if there's any like bad expectancy within your trade. So to check trade expectancy, here's the formula for it down below if you want. But trade expectancy formula will essentially tell you if your strategy or the process you're following, the thought process you're following, okay, is going to be profitable over a long period of time. If it's anything above 1, that is profitable and you're fine to go. What I mean by this, by the way, is if you're a scalp trader, do not just take, okay, this is where the formula is. If you're a scalp trader, by the way, don't just take on average like 10 trades a day. Don't be taking 15, 20 trades and be like, okay, that's it, I'm done. No, you want to be doing this over the course of a month, 2 months, before you kind of go, okay, of consistent thought processing, okay, of consistent, the thought process check being a yes, to then get okay, this is, this strategy gives me this result, rather than having an inconsistent one and going, well, you're not getting any sort of consistent results. Therefore, you're not knowing the actual consistency of your specific strategy. That's extremely important to note. Okay, but once you've done that, right, and let's say, for example, your strategy is not profitable, that is where you then go back and tinker the thought process check, tinker potentially your strategy, because that is part of your thought process check. Okay, before you actually hit any sort of button within your keyboard to enter at market, enter at limit, get into a trade or whatever. That is the most important process here. So this is a very brief kind of example of what I mean by your input process. I've created a very brief, quick diagram as to what someone I know created a while back, and something I've created before that. And it's just generally going to be asking you the following questions. This can be very wild, very differently depending on the strategy or whatever you want to be testing or going through and trading from. But do I believe this is a market structure change? If you're trying to just trade market structure changes, right? If the answer is no, well, then there's no trade. If the answer is yes, have we cleared then should be two prior swing highs / lows? If the answer to that is no, then no trade. If the answer to that is yes, okay, is this on the 50-minute or 5-minute time frame? If the answer is no, then again, no trade. If it's yes, okay, then is your risk management in check? Then proceed with the trade. That is what I mean by consistent input process. Stick this on another monitor or something along those lines. If the answer, if you follow this for those consistent 50, 60, 70 to 100 to 200 trades, and you're consistently following it, and every single time you can fill that input process box with yes, I followed this, well, then your output is much more likely to be actually reliable over an output which has no consistent input process. This is just something which makes the input process a lot easier by asking yourself these type of questions every single time you take a trade. If you're not following this, well, then the answer is no. Therefore, your output will be it will vary drastically. So this is just an example of what I mean by your input process, and something I would like you lot to create if you want to be creating this, to aim for consistency. Because then let's say, for example, the end result, like I said, the trade expectancy was negative, it's not profitable. Well, then maybe we can change this and go, okay, well, have we cleared the prior 3 swing highs? Repeat the same process again, and then come back and be like, okay, well, if it's now actually profitable, for example, yeah, well, then we can stick with this for a while and then tinker it when needed. But this is what you want to be tracking: your input process, your thought process before you take the trade, thus giving you a much more reliable output in terms of P&L. You don't want to be reverse engineering from the sense of checking your output being your P&L and going, I lost a trade, I did something wrong. No, because if you follow this process and you lose a trade, that is still a good job done in the day in the business, essentially. You're testing correctly, you're trading, you're doing your job correctly, especially after you've created a very successful, thought process, just strategy. You've done it, you followed it, and it goes, okay, you've done the process all well. but you've lost a trade, it doesn't really matter in that sense. As long as you followed this, over a long period of time and you've tested it beforehand, your output over a long period of time will be net positive, which is what you want. You don't have inconsistency, and if you have inconsistencies, you end up just consistently falling back on that wheel of this is wrong, going next strategy, this is wrong, without any sort of thought process or framework to help you determine whether your output is reliable or not. So I hope you enjoyed, everyone, and I hope you gained something valuable from it.